We are diving into a paradox today, and it's one that pretty much dictates the entire trajectory of your financial life.
Hmm.
We've all been told the shortcut to success is simple, get a high income, stack the cash, and you're set.
Stern Mall.
Just earn more. That's the mantra. It's the cornerstone of like all conventional financial advice. But what if the data actually proves that's not? That's not the primary driver.
Well, the evidence pushes back on that idea hard.
It does.
Our source material for this deep dive, it's this massive look at the top 50 evidence-based personal and behavioral finance concepts. And it shows something surprising and really, really actionable.
Okay.
A robust psychological framework, your money mindset, is statistically more predictive of your long-term financial well-being than your income level.
More than how much you earn.
Way more. We're talking about the operating system, not the engine size.
That's the shortcut you need to hear, especially when you're navigating your 30s. This isn't about finding some magic stock tip or getting a sudden massive raise. It's about fixing the software that's running the whole operation, your brain. Our mission today is clear. We are distilling the critical psychological pillars you need right now. We're shifting the focus from that tired, low-impact debate of what investment to buy to the far more empowering how to think about money.
Exactly. We are looking at the foundational elements that prevent that inevitable self-sabotage, the kind that comes from emotion-driven decisions.
Right.
And if you do that, you maximize the impact of every single dollar you earn. So if you're serious about this, about making your money work for you, this is a great time to subscribe to Money Mindset right now. Keep this momentum going.
Yeah, keep that critical evidence-based learning coming. So as we unpack the sources, we see three foundational pillars that hold everything else up.
Right.
First, self-control and future orientation. It's managing that tension between today and tomorrow.
The now versus the later.
Second, overcoming cognitive biases. Recognizing where your brain is actively trying to, sabotage your portfolio.
The glitches in our thinking.
And third, building financial self-efficacy. That's the confidence to actually implement the plan and, stick with it. If we can master these three, the rest of it, the budgeting, the saving, the investing, it all becomes systematic and, frankly, a lot less stressful.
A whole lot less.
Okay, let's unpack this dual engine of behavior. Because financial stress, it's not just one thing, is it?
No, it's not monolithic at all.
You have two totally distinct problems creating anxiety. You've got present stress. That's the immediate nagging, can I cover my bills kind of feeling.
The day-to-day grind.
Exactly. And then you have future insecurity, which is that bigger existential dread of, will I ever be able to retire or own a home? So what does the research say drives these two very different problems?
This is where the behavioral finance stuff gets really precise. So a major 2025 study, and this was data across 16 developed countries.
Wow, okay.
It isolated this exact split focus. They found that your day-to-day anxiety, your present money stress is overwhelmingly determined by one thing, your level of self-control.
Self-control. So the capacity to just say no.
The capacity to resist instant gratification. Can you stick to the rules you set for yourself? Can you resist that short-term temptation of the new gadget or the impulse vacation?
So self-control handles the immediate threat, the present chaos. That makes perfect intuitive sense. But then what about the deep-seated worry about decades down the road?
That anxiety is driven by the second trait. They call it future time perspective.
Future time perspective.
Yeah. It's your capacity to look ahead, to visualize, and to actively plan for a distant future. It's not just discipline. It's the mental muscle that makes retirement feel real.
Tangible.
Tangible and achievable, even when it's 35 years out. And the study showed these two things have very distinct roles. Self-control manages the now, making sure you're stable, preventing those small catastrophic mistakes.
And the future time perspective.
That manages the decades ahead. It ensures you're actually accumulating and setting intentional goals. If you can't envision your future financial self, your present self has absolutely no motivation to sacrifice for them.
I want to focus on that link between self-control and anxiety. It sounds like high self-control isn't just about, being good with money. It's more like a proactive investment in your mental health.
That is precisely the finding.
It's a buffer against chronic stress.
It is a buffer. The study's model showed that high self-control doesn't directly cause you to accumulate wealth. Not in a straight line anyway. But it does lead to these concrete low-stress behaviors.
Like what, specifically?
We're talking about avoiding impulsive high-interest debt, consistently sticking to a budget, And critically, paying bills on time. These are the indirect effects.
So when you have that behavioral buffer, you're not constantly putting out financial fires.
Exactly. Fires that you started yourself through impulse spending or late fees.
Mm-hmm.
And this just massively reduces chronic financial anxiety. It prevents that accumulation of small compounding debts that lead to that constant low-level dread that just saps your energy.
That brings up a great point, though. Willpower is a finite resource. It's like a muscle that gets tired.
It's a battery that drains.
Right. If I'm fighting the urge to spend $100 every afternoon, I'm going to lose that fight eventually. So the goal has to be to structure my life, so I need less willpower.
Right. You've just hit on the core insight of applied behavioral finance.
Yes.
We want to reduce the need for that constant struggle, for relying on a willpower bucket that just empties out throughout the day.
So how do we do that? What's the number one strategy?
The single most effective behavioral strategy, period, is automation.
Okay, explain how automation is more than just a logistical convenience. How is it a psychological hack?
Well, by setting up automatic transfers for your savings, your investments, your bills, and you time them to go inside precisely with your paycheck deposit. You remove the decision-making step completely.
So the moment the money hits your account.
Poof. The portion for your future security, your retirement, your emergency fund is gone. It's the ultimate pay-yourself-first strategy. It completely bypasses the emotional brain.
The part of the brain that wants to spend.
Right. It prevents that part from ever even seeing the money it might be tempted to spend. You're basically engineering your environment to make the right choice, the default choice.
Okay, so automation is our passive defense. A great one. But let's talk about active defense against the impulse buy.
Yeah.
You mentioned a powerful pre-commitment strategy that I think every 30-year-old battling, the endless scroll of online shopping needs to hear. The 30-day rule.
This is a beautiful piece of psychological engineering. The 30-day rule. It dictates that for any non-essential item above a certain threshold, let's say $50, which captures most clothes, electronics, stuff like that, you force a 30-day cooling off period. You do not buy it immediately. You physically write it down, put it on a wish list, stick it in a digital cart for later, whatever you have to do.
Why 30 days? Is there something special about that number? Why is that duration scientifically effective?
The duration is absolutely critical because it shifts where the decision is being made in your brain.
Okay.
When you see an item and you feel that immediate rush of, I have to have this now, that decision is coming from your limbic system. That's the emotional immediate gratification center.
The toddler brain.
The toddler brain, exactly. By enforcing a 30-day delay, you transfer the authority for that decision to the prefrontal cortex, the logical long-term planning center. And in almost every case, that initial urgency, that emotional excitement, it just completely fades within that period.
And you realize you didn't even really want it.
You realize you didn't need it, the money is saved, and your future self thanks you. It's a structured way to defend against impulse buys that are fueled by all that aggressive scarcity marketing we see online.
Only 2 left in stock.
Exactly that.
That is a fantastic framework for enforcing self-control. Okay, let's pivot back to strengthening that future time perspective. If a 30-year-old sees saving as this painful sacrifice, they're not going to stick with it. So we need the third strategy, which is reframing.
We absolutely have to flip the script. The default perspective, you're right, it views saving as deprivation. You're losing $100 that you could enjoy today.
Right.
We need to use cognitive reframing. We need to see saving not as losing money now, but as actively buying future freedom and security.
How does that look in practice? What does that actually mean?
It means every dollar you save should be mentally tagged. This isn't money you're missing out on. This is a deposit into your future self's life.
Oh, I like that.
It's buying them options. It's buying them resilience against an unexpected crisis. It's buying them the power to retire comfortably or maybe take a necessary career risk without panicking.
So when you internalize that you're purchasing freedom, the psychological pain of that small sacrifice today just kind of evaporates?
It transforms a perceived loss into a tangible, motivating future acquisition. And that directly strengthens that future time perspective we identified as the key to long-term security.
Okay, so now we move from managing our immediate cash flow and temptations to managing our investments.
Yeah.
And this is where the 30-year-old who they might be feeling increasingly competent, maybe a little too aggressive in the market. This is where they face systematic sabotage from within. We're talking about cognitive biases.
And these are not personal failings. I want to be really clear about that. They are systematic errors in human thinking. They're deeply ingrained mental shortcuts that, while they might have been useful for surviving on the savannah,
Right.
they were disastrous in the complex, quantitative modern financial world. And since this demographic is often making their first major long-term decisions, funding a 401k, opening a brokerage account, they have to actively mitigate these biases.
Because they consistently lead to wealth-destroying decisions.
And so
Let's start with the ego trap, the one that makes every person feel like they could be the next Warren Buffett, the curse of overconfidence. What does the hard evidence say about investors who think they're smarter than the market?
the evidence is remarkably clear, and it is consistently negative. Overconfidence is, well, it's just overestimating your knowledge, your information, and your ability to predict what the market will do.
And there's a famous study on this, right?
Odine's seminal 1998 study provided compelling proof. He looked at thousands of brokerage accounts and found that the overconfident traders, the ones who traded the most,
They engaged in significantly higher trading volumes.
exactly, way more than their less confident peers.
But why is higher trading volume a problem? Shouldn't being active lead to better results? You're engaged, you're on top of it.
It feels like it should, but the opposite is true. That hyperactivity leads directly to lower net returns, and this is for two main reasons. First, the increased transaction costs and fees. They might seem negligible on any single trade, but they systematically erode any potential gains over time. It's like death by a thousand cuts.
And the second reason?
Their trading tends to be based on poor timing. Overconfident investors are often prone to selling their winners too early to lock in a small gain.
The ego boost.
The ego boost, and holding on to losers too long or buying trendy assets too late just before they deflate. Their attempts to beat the market instead just yield returns that lag behind a simple, boring index fund.
So they're literally trading their way to lower net wealth simply because they believe they have some kind of edge or unique insight.
An insight that the market simply doesn't reward consistently. And this behavior is fueled by what Gervais and Odin modeled in 2001. They called it the danger loop.
The danger loop.
They showed that even past successes, especially those driven purely by market luck, like you bought a tech stock right before a bull run.
Right, you got lucky.
You got lucky. But that can generate a false, disproportionate sense of skill and invincibility. This creates a feedback loop. A lucky gain convinces you you're a genius trader, which prompts even more aggressive, frequent, and risky trading.
And for a young investor who has decades of potential compounding ahead of them, that pattern is incredibly dangerous.
It's devastating. Discipline, patience, and humility, not ego, are the true virtues that get rewarded in long-term investing.
Okay, so if overconfidence is driven by ego, the next one is driven by pure fear. The pain of loss aversion. This is maybe the most famous behavioral finance concept from Kahneman and Tversky, isn't it?
It is. And it defines that central conflict so many investors face. Loss aversion basically dictates that the negative psychological impact of realizing a loss is felt roughly twice as intensely as the positive pleasure of an equivalent gain.
So if you gain $100, that feels good.
It feels great, like a plus 100 feeling.
But if you lose $100,
It feels like losing 200. It's a 200 feeling. The pain is just magnified.
and how does that emotional math manifest in someone's portfolio, especially for a 30-year-old who might be new to picking individual stocks?
It results in the classic disposition effect. This is the stubborn, irrational reluctance to sell your underperforming assets.
So you have a stock that's it's a dog, and you know it.
You know it's failing, but you refuse to sell it because clicking that sell button makes the loss official. It makes the pain real. So you hold on, sometimes for years, just hoping, just praying for the stock to get back to break even so you can get out without that psychological cost.
They're driven by the sunk cost fallacy. They just refuse to admit they were wrong, even when selling and reallocating that capital to something promising is the mathematically rational choice.
The pain of the loss keeps them frozen, and that freezes their capital in these dead-end investments, costing them massive opportunity costs. But loss aversion also drives a second, equally destructive behavior: panic selling.
I can see that happening in every market downturn. The 30-year-old sees their portfolio, which they've so diligently built up, suddenly drop 15 or 20% in a correction.
And loss aversion screams in their ear, get out now before it hits zero.
Yeah.
They abandon their long-term plan, they sell their equities during the downturn, locking in the loss, realizing the maximum psychological pain. And then, this is the most crucial part, they miss the inevitable subsequent recovery.
Which is completely counterproductive to building wealth long term.
Absolutely.
Yeah.
For a 30-year-old, short-term volatility should always be viewed as an opportunity to buy assets on sale, not a threat that demands retreat. The key is recognizing that painful emotional response for what it is, a bias, not sound logic.
Okay, so our final cluster of biases are driven by narrow focus and external pressure, herding and recency bias. Let's start with herding, or as we all know it, FOMO, fear of missing out.
Herding is simply the tendency to follow the crowd. It often leads to buying popular, trendy assets like meme stocks or specific
We're
cryptocurrencies
way too late.
way too late in the cycle, usually right at the market peak. It's fueled by that powerful social pressure, that voice that says, everyone else is getting rich, I must be missing something.
I'm sure we all have a friend who bought Dogecoin or a specific tech stock at the absolute peak of the frenzy. That's herding in action.
Precisely. The problem is, by the time an investment is popular enough to generate that widespread FOMO, the upside, the rapid growth, has likely already been captured by the early adopters, the insiders, or just the very, very lucky.
Chasing hot trends is an expensive way to lose money.
Overwhelmingly so.
Yeah.
And then you have recency bias, which pairs with herding just beautifully. It gives disproportionate weight to recent events. So if the stock market has returned 20% a year for 5 straight years,
Recency bias tells you it must continue to perform that well, even if it's completely out of line with historical norms.
which can lead to aggressive risk-on behavior right before a necessary, inevitable market correction, it results in buying high because the good times will never end, and then being completely unprepared when the downturn finally arrives.
It's the opposite of buy low, sell high.
It's the recipe for buy high, sell low. The antidote to both herding and recency bias is to create some institutional discipline and objectivity for yourself.
So if the enemy is our emotional brain, our toddler brain, what's the single best actionable tactic to mitigate these biases, especially when volatility hits?
The recommendation is powerful because it externalizes your rational thinking. It's creating a written investment policy statement or an IPS.
An IPS, this is something institutional investors have to have, right?
They do, it's mandatory, but individuals should absolutely adopt it too.
So tell us what an investment policy statement and IPS actually contains. What do you write down?
It formally outlines 3 things. First, your long-term financial goals. Second, your objective risk tolerance. And third, your specific rules-based investment strategy.
So like what asset classes you'll hold, what funds you'll use.
Exactly. I will hold 80% stocks, 20% bonds. I will use these specific low-cost funds. I will rebalance once a year on my birthday. It's a contract with your future self.
And this IPS, it acts as an objective anchor, a document you created when you were calm and rational.
Which prevents your emotional self from making panic decisions based on recency bias or FOMO during a market storm. When the market is crashing, you don't think about selling. You just refer to your IPS, which tells you to stick to the plan or maybe even buy more.
The section on biases leads us perfectly into this idea of financial self-efficacy. You need confidence, right? You need the belief in your ability to manage your money to successfully resist those pitfalls and stick to that IPS.
And that confidence isn't arbitrary. It's strongly linked to financial literacy. The 2022 Fed report noted that 60% of men with a bachelor's degree felt comfortable making investment decisions. When you take control, when you build small successes, you build that confidence.
And the most basic, high-impact first step toward that efficacy is creating a real, tangible financial buffer.
The critical emergency fund.
Yeah, we have to move past the abstract idea of save some money and actually quantify the fragility we're trying to avoid. What's the specific metric that research has identified as that tipping point between stability and, well, financial disaster?
The metric identified as a really robust measure of financial fragility is the ability to come up with $2,000 within a month.
$2,000.
Just $2,000 for an unexpected expense. It sounds modest, right? It's not a life-changing amount of money.
Yeah.
But it represents the ability to absorb the shock of a major car repair, an unexpected deductible, or a surprise bill without falling into high-interest debt.
That distinction between those who can absorb a shock and those who can't, it feels crucial. Give me that data point again on financial literacy and the $2,000 metric.
The data disparity is just stunning. So, among individuals who are highly financially literate, they answered the standardized Big 3 financial questions correctly.
Okay.
Minus 37% were confident they could access $2,000 quickly. For those who answered incorrectly, confidence just plummeted to only 13.4%.
Wow.
That $2,000 is the critical difference between weathering a temporary shock and being forced to put it on a credit card. which just derails your entire long-term plan.
So that's the essential first layer of defense. It's not just about paying the bill, it's about protecting your long-term wealth by not having to go into debt for an emergency.
And that protection needs to be layered. While $2,000 is the absolute starting line for basic financial health, the full safety net is the 3 to 6 month expense reserve target.
The big one.
The big one. This larger, deep reserve is explicitly designed to protect against major shocks, like a prolonged period of unemployment, a temporary loss of earning capacity, or a serious medical event.
Now, when we're calculating that 3 to 6 month target, are we talking total income or just essential living expenses? Because that's a huge difference.
You should always, always calculate it based on essential living expenses only.
So just the must-haves.
Just the must-haves: housing, utilities, basic food, insurance premiums, and your minimum required debt payments. You don't need to fund your travel budget or your restaurant spending for 6 months.
And this money has to be safe and liquid.
Absolutely safe and liquid. A high-yield savings account is perfect, maybe a short-term treasury ETF, but never in volatile investments. The goal here is accessibility and capital preservation, not growth.
Okay, so we've built the buffer. Now let's move to the control panel of your finances. Budgeting frameworks. People get scared of budgeting. They associate it with these painful, detailed spreadsheets.
Which is why so many people fail at it. They try to do too much.
So the 50-30-20 rule offers a simpler way. It's about balance and high compliance.
This framework is built for simplicity, and you apply it to your after-tax, take-home income. It gives you a clear, high-level structure that avoids the overwhelming detail of tracking every single transaction.
So break it down for us. What are the 3 buckets?
It's really elegant. 50% of your after-tax income goes to needs. These are the non-negotiable expenses.
Yeah.
Housing, minimum debt payments, utilities, groceries.
Okay, 50% for needs.
Then 30% goes to wants. This is your discretionary spending: entertainment, dining out, hobbies, travel.
And the last 20%.
That critical 20% is dedicated to savings and debt repayment above the minimums.
Let's use a simple example to make it concrete. Let's say a 30-year-old has a monthly after-tax income of $5,000. How does the rule break that down?
Okay, so $5,000 a month, $2,500 goes to needs. $1,500 is allotted for wants, which is plenty of room to live life and not feel deprived. And crucially, $1,000, that 20%, is automatically directed toward your future goals.
Like building that emergency fund, maxing out retirement, or attacking high-interest debt.
Exactly. It's a great starting point for someone who feels like their cash flow is chaotic, but isn't ready for a super detailed zero-based budget.
Speaking of chaos, let's bring up the infamous latte factor. David Bach popularized this, and it gets mocked a lot.
It does.
Like you're telling people they can't have a simple pleasure. But the core idea is really powerful, isn't it?
The point of the latte factor is not deprivation. It's about mindful spending. It's about identifying the high-volume drips that are sinking your financial ship.
So let's look at the math. The daily $5 coffee.
A daily $5 coffee adds up to over $1,800 a year. Now, $1,800 isn't enough to retire on, no, but it is certainly not insignificant.
That's a huge chunk of a Roth IRA contribution.
It is. That sum, redirected consistently, could fund a full Roth IRA contribution over several years. That's money that could be compounding for decades, rather than just being consumed immediately.
So it's not just about the coffee.
It's not about the coffee. It's the cumulative effect of those small, unconscious subscriptions, the daily fast food lunches, the cheap impulse buys. All of it collectively drains significant funds from your high-impact goals. It starves that 20% savings bucket.
And that redirected money goes right to that 20% bucket, which brings us to strategic debt management. Once we've controlled the cash flow, what is the non-negotiable financial imperative for a 30-year-old with debt?
The imperative is mathematically crystal clear, and it has to be prioritized before any serious investing begins. Aggressively pay down any debt with an interest rate of 8% or higher.
8%. So we're talking credit cards.
Almost exclusively credit cards and
Yep.
high-interest personal loans, yeah.
Why that 8% threshold specifically?
Because paying off a debt with, say, an 18% APR, that's a guaranteed, high-return, risk-free investment for you.
A guaranteed 18% return.
You are locking in an 18% return on that dollar just by avoiding the interest charge. You will never find a better guaranteed return in the market with zero risk. That high-interest debt is like a massive parachute dragging you down. You have to cut the parachute before you can try to fly.
Okay, so that's the priority. Then investors are faced with a choice of strategy. debt avalanche versus debt snowball. Can you give us the clear breakdown of these two and who they're best for?
Sure. The debt avalanche method is the mathematically superior choice. You prioritize paying the debt with the highest interest rate first, regardless of the balance.
So you tackle the most expensive debt first.
Right. You make minimum payments on everything else, but every extra dollar goes toward that high-interest monster. This minimizes the total interest you pay, gets you debt-free, faster, and cheaper overall. It's best for disciplined people who are motivated by the math.
But the debt snowball is the psychological favorite, right?
It is, because it harnesses our psychological need for momentum and for quick wins. The debt snowball has you prioritize the smallest balance first, regardless of the interest rate.
So you get a win right away.
You pay off that small balance quickly, which generates this massive psychological boost. It builds momentum and motivation to tackle the next slightly larger debt. It might cost you a little more in total interest, but for people who struggle with discipline or need that visible progress to stay committed.
The behavioral benefits can outweigh the mathematical cost.
Often, yes. The best debt payoff method is the one you actually stick to.
Now, what if the debt is so severe that they're struggling to even make minimum payments? That's beyond just choosing a method. What's the step they need to take then?
They need to seek professional accredited help immediately. If you're overwhelmed, if you're being harassed by creditors, you should seek out a reputable nonprofit credit counseling agency.
How do you find a reputable one?
Look for agencies accredited by organizations like the NFCC, that's the National Foundation for Credit Counseling, or the FCAA, the Financial Counseling Association of America. They can provide structured advice and sometimes even negotiate lower interest rates on your behalf. You need to offload that stress to a professional.
Finally, let's talk about maximizing income. This is often framed as the highest yield investment a young person can make. You can only cut so many lattes, but your potential to earn is, theoretically uncapped.
That is the ultimate strategic focus for a 30-year-old. Because you have such a long career ahead of you, this means focusing on your human capital.
So investing in yourself.
Investing time and money in skills, knowledge, and high-demand experience. It's the fastest pathway to greater earning potential. We're not talking about another generalized degree here. We're talking about targeted, high ROI skills.
Like cloud computing certifications, data analysis, project management, things that are in demand right now.
Precisely. That specific, targeted career investment, a 3-month course, a certification, can easily yield a 10 to 20% raise in a short period. That is a massive guaranteed return compared to any market return, especially when you factor in the long-term compounding effect of a higher base salary.
And beyond the main career, supplemental income or a side hustle plays a big role for a lot of people trying to accelerate their goals.
Yes. A 2025 Principal Malaysia article looked at these global trends and suggested that even a small, consistent side hustle can accelerate financial goals dramatically. The extra income shouldn't just buy luxuries. It should be used to accelerate debt repayment or boost retirement contributions.
Think about an extra $500 a month from some freelance work. That's not just spending money.
No, that's $6,000 a year. That could be funneled directly into a Roth IRA where it compounds tax-free for decades. It's a powerful financial boost and a crucial hedge against relying on a single source of income.
We've established the psychological framework, we've controlled the cash flow, we've maximized the incoming capital. Now let's talk about putting that surplus to work for the next 30 or 40 years. And this starts with the single most powerful force in finance, the one that benefits a 30-year-old more than anyone else, the power of compounding.
Compounding is, and this is not hyperbole, often called the eighth wonder of the world. It's a geometric process. Your money doesn't just earn interest on the initial principal you invested. It earns interest on the accumulated interest from all the previous periods. For a 30-year-old, your greatest financial asset is not your salary today. It's the sheer amount of time you have ahead of you.
We have to make this point visceral. Use that illustrative data point to really drive home the magnitude of starting in your 30s versus, say, waiting until your 40s.
Let's use the specific example from the source material. Imagine a 30-year-old invests a modest $300 per month.
Okay, $300 a month.
And they achieve a pretty typical 7% average annual return over 30 years. They will end up with approximately $368,000.
Wow.
Now, here's the shocking part. Only about $108,000 of that total came from their own contributions. A massive $260,000, more than 2/3 of the total, was generated solely from interest and gains compounding on themselves.
So the gains are earning gains, which are earning gains. It's a snowball. Now, what happens if that same person waits until they're 40 to start, contributing the same 300 a month, but for 20 years instead of 30?
In that scenario, they only accumulate about $147,000. That 10-year delay cost them over $220,000.
That's staggering.
The money you invest in your 30s is exponentially more valuable than the money you invest in your 50s. It just has more time to benefit from that geometric acceleration.
Next, let's talk about the strategic use of investment vehicles. Maximizing tax-advantaged accounts. The first step for anyone with a job that offers retirement benefits is absolutely non-negotiable. The 401k match. This is free money.
It is not an exaggeration to say that failing to capture the full employer match is the single most costly, easily avoidable financial mistake a 30-year-old can make. The common structure is highly favorable. The employer matches your contribution 100% up to the first 3% of your salary and then 50% on the next 2%.
Okay, let's run that through a specific scenario. Let's say my salary is $75,000 and my company offers that standard match. How much free money am I leaving on the table if I only contribute 2%?
If you contribute 2%, that's $1,500. The company only matches that $1,500. But if you increase your contribution to 5%, $3,750, the company maximizes its match. You get 100% on the first 3%, which is $2,250, and 50% on the next 2%, which is $750. Total employer match, $3,000. By missing that final 3% of contribution, you are actively sacrificing $1,500 in guaranteed returns every single year.
An immediate 50 to 100% guaranteed return.
You must contribute at least enough to get that full match before you even think about any other investment.
Once the match is secured, the Roth IRA is often the next best account for a 30-year-old. Can you detail the unique benefit of the Roth, that future tax hedge?
The Roth IRA is funded with after-tax dollars, meaning you don't get a tax deduction today. But the enormous benefit kicks in decades later. The growth over time and all of your qualified withdrawals in retirement are completely tax-free.
And why is that so powerful for someone who's early in their career?
Because a 30-year-old is statistically likely to be in a relatively low tax bracket today compared to where they'll be in their peak earning years. Furthermore, they are strategically hedging against potential future tax increases.
Which seems likely.
Given the national debt and fiscal pressures, if Congress raises tax rates dramatically in the next 30 years, your Roth withdrawals remain untouched. It's an insurance policy. And as an added bonus, your contributions can be withdrawn penalty-free at any time, which offers unique flexibility.
Which brings us to the ultimate choice, traditional versus Roth. It's really a trade-off of when you want your tax break, isn't it?
Exactly. Traditional accounts give you the tax break now, lowering your taxable income this year, but you pay ordinary income tax on every withdrawal in retirement. Roth accounts make you pay the tax now, but you get tax-free income later.
So who is the Roth best for?
The Roth generally favors the 30-year-old who expects their income and their tax bracket to be higher in retirement than it is today. If you think you'll be in a lower bracket later, the traditional is the better play. But for most ambitious 30-year-olds, that Roth tax hedge is just invaluable.
Moving from the accounts to what's inside them, evidence-based investing, the index fund dominance. We need to talk about why the vast majority of investors should just ignore stock picking and active fund managers.
We're simply following the evidence and the advice of giants like Warren Buffett, who famously recommended that most people just use low-cost S&P 500 index funds. The case for index funds over active management is one of the most robust findings in modern finance. It comes down to data and cost.
Let's cite the evidence from the SPIVA scorecard. What does that brutal data tell us about the success rate of active managers who are trying to beat the market?
The SPI scorecard is just a consistent story of failure for active management. Over a recent 15-year period, the data showed that over 80% of all domestic active funds underperformed their respective benchmarks.
80%.
Over 80%. Think about that. 4 out of 5 highly paid, sophisticated professional fund managers couldn't beat a simple passive index fund that just holds the market.
And the primary reason for this failure is not a lack of talent, right? It's structural cost.
Absolutely. Fees and transaction costs are an insurmountable headwind. The average actively managed fund charges an expense ratio around 0.64%. The average index fund charges around 0.05%, or even less.
That difference, compounded over 30 years.
Is a massive amount of wealth that active funds simply cannot overcome consistently. Low-cost index funds are just superior.
So the winning strategy is simple. Low cost, broad market index funds. You're betting on the long-term growth of the whole economy. Given their long time horizon, what's an age-appropriate asset allocation for a 30-year-old?
They need to maximize growth. An appropriate allocation is aggressive. We're talking 80 to 90% in stocks, domestic and international, and the rest in fixed income like bonds. They have decades to recover from any short-term volatility, making this the purely rational choice. Playing it too safe now is actually far riskier.
And finally, a strategy that pairs perfectly with the automation we talked about earlier, dollar cost averaging or DCA.
DCA is the systematic, emotion-free way to execute that aggressive strategy. It just means you invest a fixed amount of money, say that $1,000 from your 50, 30, 20 budget, at regular intervals, no matter what the market is doing.
So when prices are low, your fixed amount buys more shares. When prices are high, it buys fewer shares.
And the critical benefit is that it lowers your average cost per share over time. But more importantly, it completely removes the psychological mistake of trying to time the market, which is driven by all those biases we just discussed.
Market timing is just a trap rooted in overconfidence.
It is. DCA removes the emotional burden, it enforces consistency, and it aligns perfectly with the goal of continuous long-term wealth building.
We've spent most of our time on accumulation, on how to grow the money, but we have to shift focus to protection, which is just as critical for a 30-year-old. What's the single most overlooked yet statistically relevant risk this demographic faces?
It is the catastrophic risk of losing your income potential due to illness or injury. Statistically, the risk of becoming disabled during your working years is significantly higher than the risk of premature death.
That is a genuinely shocking insight. Most people focus on life insurance.
They do, but disability is the higher probability threat to your finances. When you're 30, you have decades of high-level potential earnings ahead of you. A prolonged illness or injury can wipe that out completely.
It derails everything.
Drains all your savings, derails retirement. That's why disability insurance is an absolute imperative. A good long-term disability policy typically replaces 50 to 70% of your lost income. This isn't about covering a 2-week illness. It's about providing income for 5, 10, 20 years if you can't do your job.
And if your employer provides basic coverage, is that usually enough?
Almost certainly not. Employer-provided coverage often has severe limitations. The definition of disability might be very restrictive. Plus, the benefits are often taxable. You should seriously consider supplementing it with a private, own occupation policy to make sure you're truly covered.
And finally, we can't forget basic comprehensive coverage, especially health insurance. The Fine-Ara Foundation study quantified this fragility, noting that 22% of adults actively avoided seeing a doctor because of cost.
And 20% of men reported having past due medical bills. Health insurance is a critical pillar of financial stability. A single major medical event can bankrupt you without proper coverage. And, of course, you need adequate life insurance if you have any financial dependents who rely on your income. It's all about risk transfer.
We've covered a massive amount of evidence-based ground here, shifting our focus from market speculation to, well, internal mastery. Let's distill the most actionable takeaways for you, the listener, right now.
First, automate your savings and bill payments immediately. Maximize that self-control, bypass the emotional brain. Second, on the investment side, mitigate that overconfidence bias by avoiding excessive trading. Stay boring, stay consistent, rely on your IPS.
Right.
Third, aggressively pay down high-interest debt, anything 8% or higher. View it as a guaranteed high-return investment. And finally, use those low-cost index funds within tax-advantaged accounts.
Ultimately, all of these strategies, the automation, the IPS, the debt discipline, they all rely on one thing, commitment. How powerful is that psychological variable?
It's the highest leverage point. The research is clear. A 2022 study found that financial goal commitment had the strongest positive association with financial well-being of any factor they measured.
Stronger than income.
They even quantified it. A highly significant standardized beta coefficient of 2.677. In plain English, that means simply being committed, truly dedicated to your financial goals is exponentially more predictive of your long-term success than almost any other factor.
So the commitment is what bridges the intent and the actual outcome. Let's leave the listener with a final thought on how to reinforce that commitment and strengthen their future time perspective every single day.
We talked about visualizing the future. We challenge you to create a financial vision board. Retirement, freedom, leaving a job you hate. These are abstract goals. They feel distant.
Make them tangible.
Make them tangible. Put images of the dream home you want to buy, the places you want to travel, the specific activities you want to do when you retire. Put it on a board.
Make your financial future visible and immediate. Where would you put that vision board so you see it daily? What specific images would you use to reinforce your commitment and remind your present self what that 20% savings bucket is truly buying?
That daily visualization reinforces your self-control. It keeps you focused on the long-term compounding rewards rather than the temporary gratification of today's impulse buy. It's a simple, powerful psychological tool to drive decades of financial success.
We hope this deep dive into psychology, strategy, and evidence empowers you to take control of your financial narrative. Go build that future.